Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, how do you protect yourself from a stock market collapse? Answer by Bob Barker. There are many ways to limit your losses, but they offer varying degrees of protection. First, you have to differentiate between a crash and a bear market. 1929 and 1987 were crashes. Unless you had some form of negative correlation protection in place prior to them, you paid the piper. Bear markets like 2000 and 2008 took 18 months to unfold, so they offered lots of time to react and adjust. The buy and hold types recommend diversification and reallocation. As far as I know, that's just a way to spread the losses across various sectors, hoping that some don't lose as much as others. But you will lose. Would you consider losing, say, 35% in 2000 or 2008 when the market lost 50 plus PCT being protected? Some will recommend gold. Sometimes gold correlates, sometimes it does not. It's an iffy proposition for protection. Some will recommend stop loss orders. That's fine in a correction, but in a crash, you have no clue where the fill will be at price gaps through your stop loss price. Again, iffy. You could write covered calls, but that provides only limited downside protection, and if your stocks crater, you won't be able to continue doing so without locking in a loss. Others will recommend buying puts. That offers several problems. At current floor levels, portfolio hedging might cost 6 to 8% a year. That's an awful lot of portfolio drag to overcome if the market stagnates or moves up modestly. In addition, since they're going to be OTM, you are risking a cost plus a deductible, which is the loss from current price down to the put's strike price. You can reduce the deductible by buying a higher strike, more costly premium, or you can reduce the premium cost by increasing the deductible. But either way, if there's a decent amount of loss potential, long stock plus a protective put is synthetically equivalent to a long call. So by buying puts for your long stock, you are effectively buying calls. As you know, calls only work if you get enough of a move by expiration to offset their cost. If the stock doesn't move up, you lose. Exactly what happens with long stock plus long protective put. If you are comfortable with giving away much of the upside protection, a way to reduce/eliminate the premium cost is to collar long stock by selling OTM covered calls to fund the cost of the protected puts. Note that collared long stock is synthetically equivalent to a bullish vertical spread. Verticals have a limited RR profile. There are other sophisticated approaches which I will just mention. 1. Buy inverse ETFs. 2. Run a long/short portfolio. 3. Short stocks and ETFs. As far as I know, no one can predict when the market will crash or correct significantly. Many will guess and a few will be correct. The wiser approach is to recognize that severe market downturns such as the 2000 dot-com bust and the 2008 subprime meltdown did not happen overnight. For those who aren't oblivious, in such events, along the way it becomes obvious that market metrics are deteriorating, economic indicators turn down, earnings announcement disappointments increase, analyst downgrades and earnings revisions increase, the VIX increases, all beginning long before the crisis becomes acute. React, don't predict. Transitioning to cash or quality debt is something that any experienced investor can achieve. If God forbid one takes off the long-only tunnel vision blinders, one can even go short a small position and transition to more short as the market drops further. Let your portfolio's declining value dictate the transition from long to short, and vice versa. I got out of the way in 2000 but didn't go short big time. I transitioned out of my holdings in 2007 and went short in 2008, slowly at first. I'm getting to be an old fart, so protecting my cities as well as the previous 5 years of gains was more important to me than the chance that I could exit and miss out on some upside gains. The market going up without me bothers me a lot less than it going down with me, unless I'm short. Markets don't melt up, you can always get back in. Answer by Pionand. The best and only way to protect yourself from a stock market collapse is to become a value investor. As a value investor, you should and invariably will take following steps. Thoroughly investigate the company's business model, quality and integrity of the management, company's past performance in terms of profitability, liquidity and solvency, length of the uninterrupted dividend-paying history and so on. Find out the intrinsic value of the shares. Buy stocks/shares only at or below their fair value. Well, how are the above steps going to protect you from a stock market collapse? Scenario 1. Shares bought/held below fair value. The answer is simple. Let us suppose that you have found that a particular stock is issued by a wonderful company that is worth keeping in your portfolio. You have determined the stock's intrinsic value is $1.02. The stock market collapse has brought down the price of the share to say 40 US cents. You hold 500 pieces of the particular stock at an average holding cost of 57 US cents. Let us assess this scenario carefully. Because of the stock market collapse, the stock worth $1.02 is available at 42 cents. You are holding 500 shares at an average cost of 52 cents. Now are you at a loss because the shares you hold have notionally lost 10 cents apiece? Or are you staring at a wonderful opportunity of buying shares worth $1.02 at 42 cents, a discount of a whopping 59%? In this situation you have not lost $50, being the difference of 10 cents by 500 between the current market price and your holding cost. You will not lose till you actually sell your holding at 40 cents. Actually, you have great opportunity in front of you to buy stock worth $1.02 at 40 cents. If you buy 500 shares at 40 cents, you will bring down your average holding cost to 46 cents, and this is called dollar cost averaging. Whether you buy more shares at the beaten down price or not, having bought shares below the fair price as well as the intrinsic value, you are safe. You do not need any additional protection. Scenario 2. Shares bought/held far above the fair value. Now suppose Mr. Generous had bought the same stock at various prices ranging between $1.50 to $2.50, and the average holding cost of his 500 shares is $1.75. In this scenario, the stock market collapse has seriously eroded Mr. Generous's investments by 74%. If he holds on to his investments, sits tight through the storm, even Mr. Generous does not lose anything. Only if panics and sells he will take a big loss. However, even if doesn't sell, having made the grave mistake of purchasing the shares far above their intrinsic value, his investment is always at risk. Conclusion: you can protect yourself and be in a safe and happy zone in the first place by keeping wonderful companies in your portfolio. See a list at Portfolio 2K15, and secondly only by buying these shares at prices below their intrinsic values. Answer by Ankit Jaiswal. Nobody knows when the next crash will take place. However, we can definitely take measures to protect our portfolio from the next stock market crash. Like we can hedge our portfolio so that we aren't much affected in case of any mishap in market. The following are the measures which you should keep in our mind to protect yourself from the next crash. A. Set our allocation between stocks and bonds at level that we can accept in a down market. Start at 70-30 as a baseline, and then decide if you can handle more volatility. Also read How to Invest in Mutual Fund Scheme. B. Keep your debt low. Handling a bear market is about a lot more than our investments. We need to take a holistic approach to our finances. Keep debt levels down will help us weather a stock market crash. C. Don't invest money in the market that you will need to spend in the next 5 years. You may do NSE Academy Certified Capital Market Professional course to learn different areas and aspect of stock market. D. Invest primary in index funds. They are inexpensive and outperform most actively managed funds. As importantly, when they are down, we don't have to worry about whether the money manager has lost his or her touch.